Welcome to the current federal tax developments for the week of October the 5th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. I'm Ed Zollers, and this week we're going to look at a few developments here in the area of federal taxes. We have a couple of final regulations that came out, one on entertainment expenses and another on withholding on what's essentially normally retirement and pension payments, both of which pretty much just adopt what we had as temporary regulations issued earlier. We're also going to discuss a special IRS ruling that came out earlier in September that I hadn't discussed when it came out, but I got asked to discuss it on a program, so I thought I'd discuss it here too, as long as we brought that up. Dealing with S corporations, the GILTI tax, and a change the IRS made in final regulations that complicates certain situations with S corporations and the election that we're going to have to get around that complication. Finally, we're going to take a look at the fact that for first time in over a month, we had the SBA give us some brand new guidance on Paycheck Protection Program loans. In this case, looking at what happens in the case of an entity that borrowed money for payroll Paycheck Protection Program loan, but now there is a partial or complete transfer of ownership of the entity. How does that impact us with the PPP loan program? And we have some guidance from the SBA on that issue. So let's start out with our first piece of guidance this week. This is the final regulations that deal with meals and entertainment expenses. This is Treasury Decision 9925, issued on September 30th. And these are final regulations that attempt to explain the changes in the Tax Cuts and Jobs Act on meals and entertainment. Now, you may remember part of the Tax Cuts and Jobs Act was to remove entirely any deduction for a business for claiming entertainment expenses, subject to one major set of caveats that we'll talk about here in a second. And then secondly, there was a major concern as to whether meals were considered entertainment for the most part, and if they were, if we had lost that deduction entirely. So these regulations were meant to deal with both of those issues, specifically to tell us what we discovered in Notice 2018-76, that yes, meals would still be deductible, and give us actually how it's probably even more favorable these days to get a deduction for meals than it was before, and also reminded us that there are still some types of entertainment that will still be deductible depending upon certain exceptions found in Section 274E. Now, the basic structure here is we're going to talk about the issue here under the regulations. We were looking at initially a basic definition of entertainment. And generally, this is kind of a, I know it when I see it type of definition. Officially, the title talks about it's any activity which is of a type generally considered to constitute entertainment, amusement, or recreation, get the right name in there, such as entertaining at bars, theaters, country clubs, golf and athletics clubs, sporting events, and on hunting, fishing, vacation, and similar trips, including such activity relating solely to the taxpayer or the taxpayer's family. This is an objective evaluation. We look at it and we try to make sense of, does it appear the principal reason for this activity is entertainment based, or is there some other aspect of it? So for instance, if you are, let's say, in the fashion industry, then a fashion show where you show off your garments, that may very well be for you an important advertising promotional type activity that's not really entertainment. It's really part of your sales activity. Conversely, though, a similar activity put on by somebody who's not there, let's say who paid for people to attend such a fashion show, that's probably going to be entertainment, right? It looks closer to that. Now, food and beverage are a special category. And food and beverage are generally not considered to be entertainment. But there are obviously special cases where food and beverages are consumed at the same time as an entertainment event takes place. In fact, most entertainment events, to be totally honest, have a factor in them quite often that we have some way of getting our food and beverage during that event. You go to a sporting event, you have the hot dogs, the beers, and all the other stuff you tend to get there. You may also have, you go to the theater, You may have a food, drink option either as part of your ticket for the entire event. I know the last time I was attended an event on Broadway, they offered various packages that would have included that particular part of the night's entertainment in the package, or you might have it just right before, right after. So we have all these various structures. And so what we end up getting here in the regs is they went back and picked up that 2018 notice. And again, like 2018-76, notice 2018-76, that basic rule is as long as there is truly separate billing, then you can go ahead and you can claim a deduction for the meals and you'll get 50% of that. You won't get a deduction for the entertainment. So, clear example, you buy tickets to a sporting event. Those are considered entertainment, non-deductible. However, while at the sporting event with your client, you buy the hot dogs, beers, or whatever else you're consuming at the stadium these days, which quite often is way beyond hot dogs, beers. There's all kind of options at the stadium. Those amounts you get for food and entertainment, for food I should say, and beverages at the game, as long as they're separately stated, they can be 1/2 deducted. Now, if instead you buy the whole package deal, where you buy a package that you get tickets and you get the food and beverage included in the mix without a separately charged and separately stated item, that will be totally non-deductible, totally entertainment. This obviously complicated the use of things like skyboxes, because normally pre-Tax Cut and Jobs Act, the teams would throw in various types of food, quote, free food as part of the deal. If you paid to get the skybox, you'd get the service of all that food and drinks and other items as part of your deal. You did pay for it, as we all know. Those tended to be rewritten ever since the Tax Cuts and Jobs Act to take into account this need to separate the two up. Now, I realize this year with COVID-19, we've had a bit less of that sort of thing going on. Just watching games, TV, watching football games and other things, you're seeing either no fans in the stands or a much reduced number of fans in the stands. And we have the practical aspect that some of our clients clearly, or we may not be comfortable attending such events. So it's not a slam dunk that taking the client to a football game is such a great idea. So we probably see this less. But obviously, as we start to get out from under COVID, we get this under control, we'll probably begin to again see this sort of thing with entertainment. Now, as I said, the test is basically objective. We're going to look at ways around this to determine if it's activity or not, and it's really going to be a common sense type of a test. Now, the IRS also reminds us, though, that there are a number of exceptions at 274E. And the 274E exceptions to what's considered to be considered to be entertainment still apply. And those include, are discussed in the regulations, expenses that are properly treated as compensation either to an employee or a contractor. We'll get into that exception comes into play as well. If we get to the special rule for reimbursed expenses, now be careful there. I've had that misinterpreted by people. When we talk about this exception of 274E for reimbursed expenses, that says that the employee who pays for the meal, let's say you agree to reimburse one of your staff members for taking a tax client out to a meal. If the employee submits the bill back to you, the employee will not have the deduction disallowed. And that's necessary on paper because, again, the accountable plan rules say that's not part of income, generally as long as it's considered a business expense. So this covered that. We could reimburse our staff member, pay for that meal. The staff member does not include that in their income, and also therefore doesn't face a 50% disallowance or 100% if it's entertainment. But the entity paying it, the employer who pays that reimbursement, they will be disallowed. A similar rule will apply for contractors. If a contractor does fully document the type of expenses, you have this deal where the contractor incurs expenses and you only pay for them if you fully document, and you've not agreed on the shift of who's going to get stuck with the disallowed deduction, then if once you reimburse that, the contractor will get a full deduction, but then you, having paid that to the contractor that was specifically identified as meals or entertainment, will face the partial for meals or full disallowance for entertainment that otherwise applies under the appropriate section. And why would you see this sort of thing? Well, meals are probably more likely. I really can't think of it, and I see this because quite often when I'm doing continuing education programs on the road, which the last time I did that was in February, but when I go back to doing that, the entity paying for the course, whoever is calling me to come in, will generally pay for my hotel, and they'll also pay as normal for the per diem, for the meals, because obviously I'm having to incur meal expense on the road. I'm not staying at home. I don't get to make my own meals in my kitchen. I have to get what I can from whatever source is available at the location I'm at, which probably means using restaurants. So quite often we will have to account to the people who are hiring us for the meals that we had while on that trip, or use a straight per diem. You have a couple of ways that might be structured, but in either case, I don't get hit with a disallowance, whichever way you're going to reimburse the structure. Rather, the disallowance goes back to the customer, who now has the disallowed meals expense because they're paying for meals for an instructor they brought in for the course. So, that's kind of the issue there with reimbursed expenses. Now, the real fun one we have, and you do want to go back and check this in the regulation, is if you have recreational expenses for your employees. Those are considered 100% deductible as long as it's not primarily for the benefit of highly compensated employees, which are generally officers, more than 10% shareholders, or other employees that are on the highly compensated list for qualified plan purposes. If you cover everybody, basically, the Christmas party is deductible. In 100%, that includes both the meals and the entertainment component of it, which is kind of interesting that we can get that. They also talk about the next category of ones. If you make food or beverage available to the public, there the test is more than 50% of the amount has to be available to the general public. There's a definition of the general public that does not include any employees. Certain other specified individuals will not be considered part of the general public for this purpose. And if they actually consume over half of the food or half the entertainment, then you don't get this exception. So you have to check that in the reg, but that didn't change when we discussed it back when the proposed regs came out. Similarly, if you have goods or services you actually sell to customers, yeah, we don't get a 50% disallowance. As I mentioned back when these regs came out, if I'm a restaurant, I'm selling food to the general public. When I'm a restaurant, I don't have to have a 50% disallowance for the meals because I am clearly incurring expenses related to meals, but I'm selling those meals to the public. So for that reason, I go ahead and get the full deduction. Now, as always, these regulations can apply for tax years beginning basically after December 31st, 2017, actually just any expense after that date. And until the regulations were finalized, so until just recently, you can still use Notice 2018-76 if that was more appropriate for you. If there's some difference there, there aren't many, but if there's some minor difference, you can still use that up until the date these got published, and these got published on the 30th of September. So, the date things are going. Actually, it didn't get published that date. I should change my statement. These so far have just appeared on the IRS website. They've not yet hit the Federal Register. That's somewhat important because the ones that get published in the Federal Register are the official, and it is possible there may be some minor changes in the regulations when they hit the Federal Register. We have seen that earlier this year. For reasons that aren't entirely clear, the IRS has started publishing these regulations on their website well before they make it to the Federal Register. Used to be until this year, for the most part, the first time we found out about final regs was when the Federal Register put out their preliminary notice they were ready to publish. And that was when we would discover that, there are final regs coming on this topic. So it is possible these will change, but not terribly likely they will do so in any material fashion. Same thing applies to the other regs on periodic payment withholding. This was Treasury Decision 9920. It came out on September the 28th. Now, these are regulations on withholding on payments, periodic and quote non-periodic payments, generally related to annuities and retirement plans. And why these were needed was because previously they were tied very closely to wage withholding. Wage withholding no longer works the way it used to. And because of that, this complicated what was previously the old exemption route that we would use for these wage withholdings for these items on periodic payments. So the IRS has now said in these regs, they pretty much adopted what they did earlier for those receiving periodic payments from pensions. And what they've really done, which is kind of interesting, is they pushed everything to the instructions. So now, according to this, they tell us that you withhold as if it was a payment of wages to the employee for the appropriate payroll period. If they don't furnish a withholding certificate telling you what to withhold, then go read the instructions. I mean, that's basically what they say. Technically, it says look at the forms, instructions, publications, any other guidance, which may even be on their website, that the IRS publishes. That's where we're going to get the guidance. Why there? Because that's a lot easier for the IRS to change than going through a formal restatement of regulations. And my guess is they like having flexibility in this area. So that's how it's going to be done. We're also told that essentially the treatment's going to be very similar to wage withholding rules. So essentially we have to do it. We have to have this withheld. If we get no certificate, the IRS tells us what we have to do. They have standard default rules. So that's very similar to what we had before. And again, these will apply to withholdings beginning next year on these non-periodic payments. In the interim, we were kind of treading water by continuing to use the old system, as if we still had the old withholding system. So we're slowly swapping over to the new one. Now let's go on to the thing that was published earlier this month, actually beginning of September, I should say earlier last month. But I was asked to talk about it on a program I was asked to tape in the past week. And so because I had to write up stuff and get ready for it, I decided I would talk about it here on this week's program because it may be of interest to some of you. I had initially decided not to pick it up because I thought that most people listening to this program are probably not people who have lots of clients that have GILTI tax issues, and especially when we change from the hybrid method to what is going to be the aggregate method, the final regulations, and we'll talk about what those are. But especially when we went that route, it became an issue of you only worried if your client had a 10% or greater interest in the controlled foreign corporation in question, and that would include direct or indirect. So if your client was merely a corporate shareholder, let's say held shares in S corporation or partnership, and you hold like a 2% interest, and the S corporation or partnership has a 12% interest in that controlled foreign corporation, well, 2% of 12% is a very, very small interest in the stock, and that means you won't be a 10% shareholder unless you've got some other interest involved, and if you do, you've probably been all through the subpart F and GILTI issues before. So, yeah, I thought it wasn't a big deal, but it can be. So let's discuss what happens, because if you do have an S corp that owns an interest in a controlled foreign corporation subject to the GILTI tax, and the GILTI tax is the Global Intangible Low Tax Income Tax, which, by the way, does not require the CFC to have any intangible asset, and technically doesn't really, well, it kind of computes what's called low tax, but not really. So you can say it's misnamed. It is a very rough justice system that was meant to discourage companies from offshoring their intellectual property. And it does so in, as I say, a rather simplistic and so very rough justice method of achieving that goal. And what we do in that case is we compute on the foreign corporation an amount of income that is separate from the prior subpart F. Now, if those of you remember the subpart F system, that system, of course, we kind of treat that, or previously, well, currently, for an individual, which is how these are going to be treated, we look through and that subpart F income is taxed to the individual shareholder or the individual partner, right? Whoever's there. So the shareholder picks up, I should say, the subpart F income. Now, GILTI looks at that income that was not considered subpart F in the past, which would have included those earnings from the intangibles, etc. And that is where we look there for having excess earnings. And what we're looking for there is having earnings that are in excess of what's deemed to be a reasonable return on the hard assets that are involved in the generation of that income. And if we have too high of a return and we have a tax rate imposed by the taxing country that's not higher than a set level, then we end up having to pick up those numbers in our income and therefore start paying a tax on that flow-through income. Okay, fine. Now we get to the quirk about how we report partnerships and S corporations. Traditionally, we worried about this in a partnership context, but it does have some implication for S corporations. Normally, if we look at something in a partnership, we either look at a partnership for tax purposes and we treat it either as an entity. So, for instance, a partnership or an S corporation decides on its method of accounting. The method of accounting of the shareholder or the partners does not affect the method of accounting at the S corporation or partnership level, and vice versa. I can buy shares in an S corporation, reporting on the accrual basis of accounting. That will flow through to my tax return computed on the accrual basis, but otherwise my individual return will be on the cash basis of accounting. That's because that is a wholly entity-driven test for the S corporation. Conversely, let's talk about a 1231 gain incurred inside the S corporation or the partnership. That 1231 gain, we know we have it, but we can't determine if that's taxed as a capital gain or ordinary income. And we don't determine that until we flow it out to the individual return, and then the individual combines that 1231 gain or loss with the other 1231 gains or losses, as well as considered any carryover 1231 loss recapture in the past 5 years that we need to worry about. And based on that, we then determine how much, if any, of that 1231 gain will be taxed at capital gain rates, how much will be dealt with ordinary rates. And that depends entirely on the individual. So there we look at this as an aggregate. So we have 20 equal shareholders in the S Corp, each one of which has 5% flat interest, let's say, so everybody's even. We just look at that. Each one, we just test every shareholder separately with regard to the 1231 assets, rather than doing a test at the S level and making our determination there about how the capital gains, etc., will be treated. Now, for GILTI, they decided to try to do what they called a hybrid method in the proposed regulations. Under the hybrid method, if the S corporation was, quote unquote, a U.S. shareholder, meaning it had a greater than 10% interest directly or indirectly in the controlled foreign corporation it owns shares in, then we would actually do kind of a really weird calculation. For all shareholders that would also be U.S. shareholders of that entity, at least if we added in the S corporation's ownership, we had to add in their share of the S corporation's ownership in that CFC. We'd treat those as passing through to them, and they'd report on a personal return along with the other shares they might hold as part of their CFC and as a U.S. shareholder. But then for all other other partners or S Corp shareholders who would not qualify to be a U.S. shareholder, that tax would be paid by the S corporation or partnership at the entity level, so-called a hybrid method. The final regulations, the IRS agreed that would be complicated, messy, and said, okay, we're going to go back to a pure aggregate method. So in the aggregate method, we're going to take a look. Each partner or shareholder will tell them how much GILTI income they have, how much inclusion they have. We'll tell them the ownership interest, their share of the ownership interest in the CFC. And then they will make a determination on their own if they are a more than 10% shareholder. Now, obviously, if the S corporation owns, let's say, 90% of the CFC and you own 50% of the S shares, then yeah, you're going to be a U.S. shareholder. But if you only own 1% of the S Corp, then yeah, you won't be if that's your only ownership interest in the CFC. So the idea is that 50% S Corp shareholder will report the GILTI income and do all the calculations, and that 1% shareholder will not have to deal with this whole regime. So people that own a very, very minor indirect interest, and that's their only relationship to the CFC, will not be subjected to this tax. Only those that have a greater than 10% interest, either via the S Corp holding or via the S Corp holding plus other holdings directly or indirectly that may be involved. So, fine. We went to this aggregate approach in the final regulations. That's great. And that's fine in a partnership because what's going to happen is when I report that GILTI income, that's going to increase my basis in my partnership interest. And if the partnership makes a distribution to the partners that allows us to pay our GILTI tax, and we probably would like to get something to pay the tax, then that's no problem because I got basis from the GILTI that allows me to get a distribution and not have any tax consequence for that distribution. In an S corporation, again, that GILTI is going to count as a pass-through of income. So that's great. But we run into a problem. Now, if the S corporation has no accumulated earnings and profits, it's always going to work out just like the partnership. That distribution, although it had to be on a per-share basis to everyone, we couldn't have a distribution limited to those who have GILTI inclusion. You could have a situation like that in a partnership. But in S Corp, you can't. But still, it won't be a problem. The people with GILTI income will have increased their basis in their interest, and that distribution would decrease it, and we're fine. But our problem comes if our S corporation has accumulative earnings and profits from a prior C or from merging with an old C corporation, that in some way it has earnings and profits that existed when we rolled into this. If we have such earnings and profits, now we have a problem. That GILTI that I'm paying tax on, I'm the 50% shareholder, so I own indirectly 45% of the CFC. That means I'm a U.S. shareholder. I'm going to pick up that GILTI inclusion. That increases my basis, but it does not increase the AAA of the S Corp. If that S Corp, because AAA is a corporate account, basis is an individual account. Because we have that no increase in AAA problem, now we have an issue. If the S corporation does not have sufficient AAA and tries to make that distribution, it will come out as a taxable dividend out of earnings and profits. So I can't, so it's kind of that insult to injury. Not only do I have to pay tax on the GILTI inclusion, but I have to now pay tax on the amount that the S corporation is distributing to me to allow me to pay the tax. So they said, okay, we kind of understand why that's, that's a consequence that probably shouldn't occur. So why don't we fix that? So they give us an election. If your S corporation has accumulative earnings and profits on September 1st of 2020, right? So it's our transition accumulative earnings and profits. We're allowed to make an election. And it's an election that is made, it can be made for the first year ending after September 1st of 2020 when we have transition earnings and accumulative earnings and profits. You could theoretically pick them up later by merging, but normally it's going to be you're there now and it's never going to happen again. So you have it as of that date. So you probably make the election on a 2020 return. And what's going to happen if you do that is we're going to have you taxed under the pure entity rules, not hybrid, pure entity rules. So the GILTI inclusion amount will become taxable income at the S level. That income at the S level will be reported by all shareholders, regardless of whether they would or would not be a U.S. shareholder under the aggregate test. But because it's being recognized at the corporate level, we're going to be able to treat that as adding to the accumulative adjustment account, increasing our AAA. That increase in AAA will assure that if we distribute cash out to pay that GILTI tax, we're going to be able to not have to pick that up as income because we will have the basis created by the GILTI inclusion, and that basis and AAA created by that is going to allow that distribution to go out tax-free. Now, it's not obvious because, again, in my example, I have one 50% shoulder and maybe I have 51% shoulders. All the 1% shoulders would not pay tax on the GILTI inclusion amount except if we make this election. Conversely, if we don't make this election, that 50% shoulder will pay tax on the GILTI inclusion amount, but now we're not getting any additional AAA. So if we try to make a distribution to help that 50% shoulder pay the GILTI, there's probably going to be a taxable dividend distribution. Again, now if you're a person who didn't pay tax on the GILTI, I prefer not to pay tax on the dividends, but I certainly don't get upset enough about it to want to pay tax on a larger number. The 50% shareholder who's going to pay tax on a larger number anyway would be much more inclined to say, I don't want a dividend on top of it. So that would be a difficult case for making the election. You got to make a decision and weigh the interest of the various parties. Again, this is not a problem for a partnership because a partnership doesn't have this AAA issue floating in there. It's also not a problem if your S corp has always been an S corp, has no E&P. Not a problem. But if your S corp has accumulative E&P and you've got GILTI issues, we got a problem, right? It can be big. This election stays in place once made until such time as the first year after you have distributed out the accumulated earnings and profits, and it has to be via distribution to get rid of it. The notice isn't terribly clear about whether that distribution notice is 2020-69, issued on September the 1st. It's not totally clear if a deemed distribution election would work, but it appears it should. So another way to clean this up, if you didn't have a lot of E&P, would be to make that distribution election. That would get rid of the E&P. That gets rid of the AAA problem, and voila, we don't have an issue. So if your client's hit by this, it's something to consider this year. This will be the year you'll make the election. In some cases, it'll be clear you want to make it because let's say, you've only got two shareholders. The CFC's owned 90% by the S corp, so they're each going to be 45% interest passed through. So they'd be U.S. shareholders, so it's a no-brainer we make the election. In some cases, if you have an S corp with unequal ownership, where only some people would be considered to be U.S. shareholders and others wouldn't, gets a lot more complicated if there's E&P around. And there you might want to have a discussion. Do we want to make this election? Do we want to make an election to distribute out the E&P to get rid of the problem in the future? Or, do we just not want to make distributions on GILTI to pay the tax? And people paying the GILTI tax accept that? We hope they do. How exactly do we want to handle this? So that'll be one of your issues to worry about. Finally, and it's been a month. We just haven't heard from the SBA recently, but we did late on Friday. Well, not as late as we have sometimes. So it wasn't like at 10 o'clock at night this time. It was just on Friday afternoon. The SBA issued something which we haven't talked about before, a procedural notice. So it's not an IFR, not an interim final rule. It's not a set of frequently asked questions on their website. This is kind of an in-between document. I would say probably the best way to view it is very similar to something that appears in the Internal Revenue Bulletin, like a revenue ruling, revenue procedure. So it's not really a regulation level, but it's also more than just something published on the website. So this is a procedural notice titled Paycheck Protection Program Loans and Changes of Ownership, issued on October the 2nd of 2020. And this was dealing with, as it suggests, the PPP loan program. So we're back into PPP loans, and we're looking at changes in ownership. So a business went out, borrowed money under the PPP loan program. Now, maybe we're going to issue new shares in the company to individuals. Maybe we're selling shares. So some of our shareholders are selling. Maybe we're redeeming shares. But for whatever reason, we're going to have a change in ownership. And that change in ownership is something we're going to have to deal with. This rule makes it clear that if you have that change in ownership, and a change in ownership takes place when at least 20% of the common stock or the ownership interest of the borrower is sold or otherwise transferred, whether in one or more transactions, including to an affiliate or an existing owner. If the PPP borrower sells or otherwise transfers at least 50% of its assets as measured by fair value, whether in one or more transactions, or when the borrower is merged to another entity. So if any one of those three things happen, we have a change of ownership. One of the key things they tell us right off is if you have that, you are to notify the borrower that there has been that change of ownership. So again, we have that change of ownership. We have to note it. And again, the key issue there is, looking at that particular threshold level as what's there. There are slightly different rules if you're publicly traded versus if you're not. Again, publicly traded, we're going to have to get one person owning 20% on a public company because public companies have changes all the time. So conceivably, more than 20% of interest could change any time. Yeah, it's just tough to know. They're looking at that point, does one person get 20%? On a privately held company, there we're kind of more aware of what's going on. So there, if we have that 20% change of ownership, then we're going to have to make that notification. And even when you have a change of ownership, some things remain the same. The borrower is still responsible for the performance of all obligations under the loan, right? Any certifications that were made in connection with the loan applications, including certification of economic necessity and compliance with every other applicable PPP loan requirement. The fact that you sold from one party, so we had a change of ownership, even if it was a 100% change of ownership, that doesn't mean the new owners get to say, we're just going to ignore this. We don't have to worry about it because we weren't there before, we didn't sign it. You're stuck on it, right? That's kind of the issue, and you still have to obtain all the documents and follow the rules. I mean, basically, all that's still there. Now, there are a few things with procedures. First thing they said, okay, let's talk about this. You have PPP loan outstanding. If you have paid off the loan, right? So either have the loan has been repaid in full or you've completed the loan forgiveness process and the SBA has remitted all funds to pay off your loan, or the SBA's remitted funds and you paid off the rest, then we don't need to worry about this. There is no special rule. The loan has been fully satisfied. And if the loan is fully satisfied, basically there's no restrictions on a change of ownership. If prior to closing or sale, those are true, we're done. Don't worry about it. Now, the more likely case is, and why we're going to be worried, because obviously it would make sense. I mean, we paid off the loan, we've satisfied the forgiveness. Are we going to have to keep notifying them for the next 6 years until the statute closes? No, that doesn't really make sense. We've kind of covered this. They've reviewed it. They've paid off. So we're good at that point. But what about the case, which is more likely, where the loan is not yet paid off? We've either not had forgiveness in full, or we've, not paid off the loan in full, or maybe we've had forgiveness, but we still have a balance to pay. So what do we do with that? Well, the SBA comes up with a couple of different subparts. There are some cases where no approval is required from the SBA prior to the transaction, but there are some restrictions. So first one is, you can sell or otherwise transfer common stock or other ownership interests. So we're not going to sell assets at this point. We're selling stock, partnership interests, something of that sort, LLC member interests, but we're not selling the underlying assets. Okay. If the sale or transfer is for 50% or less of the common stock or other ownership interests of the borrower. So if you do that, period, we're good. Majority interest stays in place, and this does consider all sales. So, keep track of them. If you go above 50, this thing changes. Or if you go above 50, if the borrower completes a forgiveness application reflecting its use of the loan proceeds and submit it together with supporting documentation to the lender, and an interest-bearing escrow account controlled by the lender is established with funds equal to the outstanding balance of the loan. After the forgiveness process is complete, then the escrow account will be released. So how are we going to contemplate that? You've sold all the stock in your corporation to a public company buyer. Okay. but you haven't yet completed the forgiveness application. Well, if you go ahead and you put this deposit, right, this interest-bearing escrow account up that would pay off the loan, and the idea is you'd use the proceeds from the sale to do that, then you would be able to, and we'd hold on to those proceeds. As long as we get full forgiveness, those proceeds would be released and the seller could get the money from the sale. If they're not released, then obviously, and the new buyer, doesn't pay off everything, then those funds be used, right? That's kind of the background. Now, the other alternative is if you have a change of ownership, it's an asset sale where somebody has sold 50% or more of the assets of the company, right? In that case, you can only do that if same basis. You complete the forgiveness application and you're going to do that interest-bearing escrow account. Okay, now, what about if we're not going that, right? If you don't meet either of those, any of those conditions, in order to get this, you have to have the SBA's prior approval for a change of ownership if you're not going to do this. And basically, what we're saying effectively is if you don't want to establish that escrow account and you're selling more than 50%, so have a change of control and you're not going to establish the escrow account, right? Then you've got to get the SBA's prior approval. And the first thing you got to explain is why you can't use the escrow account. It's kind of the first thing. You got to explain why you don't satisfy those requirements. Give the details of the transaction. Send along a copy of, and this will be submitted to the SBA Loan Servicing Center, a copy of the PPP note, a letter of intent, and the purchase or sale agreement, setting forth the responsibility of the PPP borrower, seller, if different from the borrower, and the buyer, a disclosure where the buyer has in themselves an existing loan agreement, and if so, the SBA loan number from that, and a list of all owners of 20% or more of the purchasing entity. And the SBA may require additional risk mitigation measures as a condition to approve the transaction. So don't be surprised if they want at least some money put into the escrow account to make that in, right? That could be very much something they could look at here. And SBA approve any change of ownership, the sale of 50% or more of the assets of a borrower will be considered conditional on a purchasing entity assuming all of the borrower's obligations on the loan, including responsibility for compliance with the loan term. And the sales agreements got to have that language. So you could have indemnification to the buyer, but they have to be primarily liable on satisfying the PPP loan obligations. If they're, or otherwise they're not approving this if you're not going to escrow the funds. So as you might guess, there's going to be a lot of pressure from the buyer that you're going to escrow the funds. Right, we're going to have them in escrow, right? The SBA will review within 60 days and give you a determination. So if you think you're going to complete this sale in the next week, you're sadly mistaken. It won't happen. They're going to want to take longer to approve it. And that'll be involved. Now, regardless of whether approval is needed, right, in this case, there are some things that will apply. This is also in the notice, right? In essence, nothing changes. All the obligations have to be met. If the new owners use the funds for an unauthorized purpose, the SBA will have recourse against the owners for that unauthorized use. All the requirements are in place, right? And if they have their own separate loans, let's say the buyer already had a PPP loan, they have to separately account for satisfying the PPP loan on the business they had and applied for the loan with, along with this business. And that's true even if we have a merger. We've got to separate the two loans and account for them separately, the satisfaction. So that means I can't merge because I've got extra payroll. I can't merge and bail out the company I merged, bail out the company, shall we say, that I merged with by using extra salary for the other entity. I've got to show it relates back to that business, separate business that it borrowed on its own. You can't go find somebody to merge with because I need some more salaries. In essence, that's not going to go. And you must notify the SBA Loan Servicing Center within 5 business days of completion of the transaction of the identity of the new owners of the common stock or their ownership interests, the new owners' ownership percentages, the tax ID numbers of any owners that hold 20% or more of the equity in the business, and the location of and the amount of funds in the escrow account under control of the PPP lender if an escrow account is required and being used. Okay. So If you have that, your client, has this, remember, we have separate rules. Some cases, no approvals required, but that's either going to be a less than 50% sale, or we're going to have to put the escrow account in place. And if we don't want the escrow account and we're selling more than 50%, then we have to remember we need SBA approval, and that's going to take up to 60 days to get. So again, most likely it makes the most sense if you can to clear out the PPP loan and to get forgiveness in place before we close the transaction. Now, as some of you are probably aware, that would be an easier said than done, because as of today, I'm still not aware that the SBA has actually approved any cancellation of debt. I've heard some people tell me, oh yeah, I got approval. But when you dig a little further, what you discover is, well, their bank has said they approved it. Well, that's great, but your approval is not really final till the SBA does that and funds the loan, unless the bank plans to eat it. So in reality, as of right now, nobody has that. Some borrowers were getting upset about that. They called their Congress critter. And Congress has now been on the SBA's backs and on the Treasury Secretary's backs about this. And so Secretary Mnuchin last week said they actually are going to start issuing some of the forgiveness numbers beginning next week. Apparently, as of today, I think we mentioned last week, we had 1% on September 8th that applied. Apparently, it was up to 2% as of last week, have gotten their applications all the way through the lender, and it's on to the bank. So what we're going to have now is those bank applications, they should start ruling on those this week. So in that case, that would allow this to clear up. Now remember, because of that, it does suggest the sale of a company could be very complicated. Because remember, the bank has 60 days to rule on your application. Then the SBA has 90 days. Well, let's see, the bank has 90 days, the SBA has 60 days, and it becomes 150 days. But there could be 150 days from the date you submit the application to the day there's full approval and everything's paid back. So any business that got a PPP loan, selling that business is going to be complicated, or selling even a 20% interest. Having a 20% shift in ownership interest, that's going to be a problem for those PPP loan companies. So not sure if everybody was aware that would be out there. It makes sense, but be aware of these rules. So you do want to go take a look at it. We've got the link in the materials for this particular procedural notice, and have an understanding of what's going to happen if we do have a client that's looking to have a change of ownership interest, and how we're going to have to deal with that. Well, as I said, I do have some webcasts coming up after the October 15th deadline. New Jersey Society of CPAs on October 26th. I'll be doing a session on construction contractors, special tax and accounting considerations, looking at the construction contracting industry, looking at the revenue recognition standards, and looking at tax rules, which, by the way, tax rules did not change when revenue recognition changed. So tax rules are going to be a little different. Tax PCM, percentage completion method, is still the same one it was. We don't care about the new revenue recognition standard for GAAP. But GAAP's revenue recognition standard is different, and there are some differences between prior GAAP percentage completion method and current revenue recognition when we're using input-driven methods. So we'll talk some about that. We'll talk about the tax rules, who can escape the tax rules, which now is expanded. So we get up to $26 million where we can get out of PCM in most cases. So we'll talk a bit about that and other issues. That's on October 26th. It is a webcast, so wherever you are, you're going to take that one from home. Same thing for webcast for Idaho coming up the end of the month. On October 29th, I have a course on preparing complex 1040s. That course will talk about the net operating loss rules, including the radical changes made by the CARES Act. We'll talk to you about other issues that are in place, let's say like-kind exchanges, which changed radically under Tax Cuts and Jobs Act. We'll talk to you about issues related to passive activity losses, our favorite friend 199 Cap A, and how that works in the system, the investment income tax, and things that are just on your more complex 1040 returns. And on the 30th of October, we're going to have a special session, that deals with fringe benefits for employers. And lots of that was changed by the Secure Act. It made some significant changes to retirement plans. We'll also discuss there some of the other issues that have arisen. We'll look at things in the healthcare area, including our, individual coverage HSAs that were now available to be used. So we'll be looking at some of those things, the other oldies but goodies in the mix here. So we'll have all of those neat little things that we have in the fringe benefit areas, autos, and all that other neat listed property stuff that we need to worry about there. Probably some brief discussion of the parking lot tax as well, since that's also in the mix of our friendly fringe benefits. So again, October 29th, October 30th. For the New Jersey ones, you can go to the NJCPA website to sign up. For Idaho, go to IDCPA website, and then we'll have the sign up and the registration. Again, you register at those sites. You can sign up for it if you're a member of either society. You know, when you sign up for the course for that society, you will get a discount. So check that out if you're interested. This has been the current federal tax developments for this week of October the 5th, 2020. You can catch our updates online at www.currentfederaltaxdevelopments.com. You can send questions and comments to me. I'm Ed Zollers at currentfederaltaxdevelopments.com is the best address to use to send me your inquiries. You can follow me on Twitter. My handle there is at Ed Zollers. I also follow the online discussions on the Connect sites for the Arizona, Illinois, Minnesota, New Jersey, and Washington societies. So if you post there, I'll try to watch for and respond to what you talk about. I also every so often look into Cal CPA's Tax Talk group. Don't do that quite as often as I'd like to anymore, but I do try to get a look in there from time to time. And if your state society wasn't what I mentioned, but has access to a program like that where you can pose questions back and forth to discuss, those can be incredibly useful resources, especially if the members of the society begin using them as that resource, because it's really helpful to be able to bounce ideas off other professionals. And it has proven to be a very, very useful tool among various societies. Both in the New Jersey and Arizona societies have very active Connect groups where lots of things get discussed. And it's very easy to get up to speed. And that's really helpful for state law specifics. If you have a state, like the New Jersey gross income tax or Arizona's regular old income tax, or New Jersey's new pass-through tax. You can talk about all those things on the site. Very useful. So be sure to check that out. Otherwise, we'll see what comes up this week. Now, again, we're still being tempted that, we're putting together, we're almost there for a deal, we're told. They're close. They want it. But we still don't have one as I tape this. I'm taping this at just after 2 o'clock on Saturday, Mountain Standard Time. Okay, maybe it all happened in the last half hour or so while I was talking, or last 50 minutes. I doubt it. So we'll check in. But otherwise, if we have something, I'll try to talk to you about that next week. It is the final week for October 15th. I think I'll be able to record, but obviously we're on the final deadline. Client stuff comes first. But otherwise, check in. Should be here next week. At least give you some discussion of what's going on, even if the write-ups aren't great. And otherwise, have fun. Get ready for that wonderful October 15th deadline stuff coming up. And we'll see you later as we come back here for current federal tax developments.